If this is the Gradescope system, you will go to this your page, and here you will have this link for assignment 1. Okay, and then here on this on the bottom you will have this upload submission button. You will click the upload submission button. You will select the file, which should be a PDF file. Okay, so for example, if you have a PDF file, something like this. Okay, if this is a PDF file, okay, if you will submit it, and I think this is a submission from submission interface from my side. Okay, and your submission interface will be slightly different. So for example, if I say that this is the student, so maybe I select this student. Okay, maybe this student is submitting, so you will upload it. So after you will upload it, on this left hand side, you will have this question 1, question 2, question 3, question 4, question 5. Okay, and of course I just submitted just one page only, but your assignment may be like several pages long. So here you will have to mention that it is this question number 1 on this first page, and then if you have some second page, you will mention that question number 2 is on the second page. But here there is only one page. I will just keep clicking like this. Okay, so you have to mention that which question is on which page. Okay, so in this way, once you will select it, then you can hit the submit button. Okay, so in this way you will submit it, so the assignment. So this, I think in this case I can see that this student has submitted the assignment. If I will go into the details, and it will say that this submission is a direct upload. Okay, and I think somewhere there will be an option to enter the name of your group members as well. So this is a submission. So that will be this submission. But here, once you will click on your submission, you will find your information over here. You see, my cursor is here. What does this cursor show? View or edit the group. Okay, so once you will submit it, you can enter your group information over here. View or edit the group over here, like this over here. If you will click it over here, now you can add the other name of the other group members. So for example, this student is in the group. I can, yeah, I will click add button, and maybe I need to click one more time. Another, okay, and maybe, yeah, maybe this one, maybe this one. So once you see all those names, and then you can click add, and then all of your group members' name will be also added. So I think you have to do these steps in this system to add your groups over here. Okay, so this I just showed to you for illustration purposes. Of course, I will delete it. I will delete this submission.
So only one student should submit here?
Yes, one student will submit, and then once that one student submits, then that student must add the names of the other group members after submission as per the procedure. Yeah. only one group will be, only one student will submit for the group. Okay. But you must do the work together. It's not like just one person will do the work and then submit for others. Anyway, so this is how this system will work. And how about the assignment questions? So maybe if you have any questions, you can ask about the assignment questions. Otherwise, we can start the lecture. So in the lecture, we finished this example before for the estimation of the equipment costs. So now we will consider the situation when the equipment have to be rented. Okay, can you hear me?
Yes.
Yes, we can.
Okay, so when the equipment has to be rented. So the renting of the equipment is also quite we can say popular in the construction projects. So a growing use of rental equipment by contractors and subcontractor is taking place these days. Since a rental agreement is a short-term arrangement, usually having a duration of less than 1 year, and no advance payment is normally required, a rental equipment provides contractor with great flexibility in meeting project requirements. So renting the equipment against buying the equipment is a decision which some contractors need to take. But sometimes the renting of the equipment is more is better for the contractor than simply buying the equipment, especially in those cases when we don't need the equipment for a very long period of time. Then renting of the equipment may be much convenient than buying and keeping and maintaining that equipment for a long period of time. So the person who is renting the equipment commonly provides all equipment maintenance except for high wear items. So this is one of the advantage for renting the equipment, that the maintenance, normal maintenance is the responsibility of the person who is renting you the equipment. So you don't have to spend your time and expenses on the maintenance of the equipment. But this is with an exception of the high wear items. Another option for the renting of the equipment is that it is the rental purchase option, which means that you can rent the equipment for some period of time, and after that time you have the option to buy that equipment. So in that case, whatever the amount which you have rented, some portion of that amount can be offset against the purchase price of that equipment. So sometimes this type of option is also available. Because it may happen that maybe once you use the equipment and you are very happy with the performance of the equipment, and you also foresee that you need the equipment in the future, so you may go for this rental purchase offer if it is available. Another term which is used as the leasing. Leasing is also renting, but the difference, general difference between the leasing and renting is that in renting there is normally no fixed period commitment. So that means you rent the equipment for 1 week or 1 month or 2 months, like that. And then if you don't need that equipment, you can return that equipment. Okay, so at any time. So it is based on the monthly subscription. Okay, monthly or weekly subscription. But in the leasing, there is some fixed period for which you have to commit that you will rent that equipment. So maybe 1 year, maybe 2 years. Although you will be just leasing it. Leasing is not purchasing. You are not the owner of the equipment. Okay? So this is the difference between the leasing and the renting. So leasing comes somewhere in between the buying and renting. So nowadays, a trend toward increased leasing and renting of the construction equipment. So some of the reasons for this trend is that the cost of equipment is increasing day by day. So therefore, not every contractor is capable of buying and maintaining those equipment. Also, there are rapid changes in the equipment technology. So it means that once you buy that equipment and you don't use it for sufficient, so you don't use it sufficiently, a new equipment will come which will be more efficient than your old equipment. So then in that case, your old equipment will not be very economical for you to use it. So rapid change in the technology. And sometimes there are also fluctuations in the rate of the demand for the construction services. So sometimes for the contractors, there are a lot of projects available. Sometimes they don't have many projects available. So there will be a fluctuation in the demand of the equipment as well. So in all those situations, it may be better to rent the equipment or lease the equipment. So therefore, for this reason, some construction companies make it a policy to rent or lease all major items of the equipment. So as a policy, they adopt this type of arrangement, either to rent the equipment or to lease the equipment instead of buying the equipment. Okay, so with this thing in mind, then we can say that leasing is then an intermediate between the two, that is the renting and the buying. And it may be a best solution when the capital is limited and the equipment utilization is high. So remember that later on, we will also find in that same result in the example that buying the equipment may be more beneficial if you want to use that equipment for a longer period of time and its use is quite heavy. Its use is quite heavy. So then in that case, buying the equipment may be much cheaper. But on the other hand, you can lease the equipment for a longer period of time. So you can choose the leasing option when you don't have enough capital to buy the equipment. You have only that much capital to lease the equipment. So, and its utilization is also high. But on the other hand, the utilization of the equipment is not too much, and you don't need the equipment for a longer period of time. Then you will only be renting the equipment. And then as has been said that lease with the purchase option may also be available in some situations when you just lease the equipment. And then, for example, after the lease, you may have the option that you can even buy that equipment at some reduced price. Okay, so that was about something about the lease, buy, and rent. Any questions about this? Okay, so if not, then you have over here is the example 7-1 or 2. I think this example number may not be correct. This is example, oh, okay, this is the 7th example in this case. Okay, so I will say that example 7. This is example 7 and the first slide of the example 1, example 7. Analyze the cost of renting, leasing, and purchasing an item of construction equipment under the conditions described. So some of the data has been given to us. Under these conditions, evaluate the total net after-tax cash flow and its present value. So these are the basic assumptions. So in this case, some of the data has been given to us. So this first set of data is for the buying the equipment. Then we have some data available for the leasing the equipment, and then we need some have data for the renting of the equipment. So we can use this data to create the table for purchasing, create the table for leasing, create the table for renting. So for each option, we find the present worth of the present worth or present value of the net cost. So here we can find that The present value of the net present value for the buying case is $57,785. The present value for the lease option is 76,668. And the present value for the rental is the $138,576. So the cheapest option available over here is $57,785. Okay, so which means that if you use this equipment for 5 years, so the present worth of this will be $57,000. So it is cheap. If it is cheaper in this case to purchase the equipment rather than lease and rent the equipment. Purchase or buy means the same. So how this number was calculated? So this number was calculated based on the data given to us. Okay, so now let's look at this data which was given to us. The data which is given to us is about the first data which is given to us is the company's marginal tax rate is for 46%. So it means that the 46% tax will be deducted from the company's income minus expenses from the net income. Okay, 46% tax will be deducted. So for example, if the net income of the company in a certain year is $100,000, so out of that $100,000, $46,000 will be deducted as a tax. Companies after tax rate of return is 8%. So after paying the tax, so whatever the amount is left, this amount will be evaluated for an interest rate of 8%. So this is the after tax rate of return, 8%. The planned equipment use is 2,000 hours per year for 5 years. So this is what we plan for that equipment, that we will use that equipment for 2,000 hours per year. Okay, so now the purchase information, the equipment can be purchased for $150,000. Its estimated resale value after 5 years has been estimated as $60,000. And for the depreciation purposes, this will use a 5-year ACRS method. Remember that this is not MACRS method, it is ACRS method, which is another method. We don't have to worry about what this method is, as it has been given that in the first year you will deduct 15%, second year you will deduct 22%, third year for 21%, fourth year 21%, and fifth year 21%. Okay, so these will be the depreciations made. The investment credit is $15,000. It means that the investment credit means that sometimes the governments give some incentive that if you, instead of renting the equipment, if you buy the equipment, we can give you some credit. Okay, that means if you it may be the credit from the taxes. Okay, like that. So that means if you have to pay like $50,000 tax, so we can deduct $15,000 from that. So because you have made some investment into some equipment. Okay, so that is called as the investment credit. So this is a kind of this is a benefit, $15,000 that you will achieve if you will purchase this equipment. Okay, so this is some sort of data which is given to you. And what we have over here is the cost basis. So cost basis is $142,500, which is basically 1/2 the investment credit less than the cost of the equipment. So this is some sort of thumb rule, or maybe some of the condition for the depreciation. That means if the government says that if you are using this investment credit, then you cannot use this $150,000 cost for the calculation of the depreciation. You will deduct half of this investment credit amount from that, and then $142,500 amount. So this is not based on something like some scientific formula. This is based on some rules and regulations. Okay, so this is some kind of rule that you will use this $142,500 instead of $150,000 for the calculation of the depreciation. And did you understand my point over here? Hello, anybody listening?
Yes.
Okay. Okay, so the next is the down payment, $30,000. Yeah, this is another condition. Down payment means will mean that if you why you will need the down payment. Normally, what will happen is that you will buy this equipment $150,000. Okay, and you will what will be the normal situation? You will if you have this amount with you, okay, that means you have $150,000. Okay, that's fine, then you can buy it. But we are assuming the situation that a contractor will buy this equipment when the contractor does not have that $150,000. Basically, the contractor will take a loan from the bank, but the condition for taking this loan is that the contractor must at least provide a down payment of like 20% of the cost of the equipment, which is $30,000. And then they will give you the loan. Okay, so after $30,000 down payment, then they will give you. Hello. Okay, so after that means you will make a down payment of $30,000 to the bank, and then you will get a loan from the bank for the remaining amount, $120,000. Okay, so or you can get $150,000 from them, but they will you will pay back $30,000 to the supplier, or the bank will directly pay $30,000 to the supplier and then give $120,000 as a loan. Or maybe, I think in that case, the bank will give a guarantee. So the bank will provide $150,000 to the supplier and then get back $150,000 from the from the contractor. So in that case, a net loan of $120,000 is taken. So the loan period is 36 months. The loan interest is 12% per year. And based on these values, it has been calculated that the monthly payment will be $3,985.72. Okay, so this is just for our references, but we will use this type of schedule for the annual payments. Okay, it has been also provided to you that at the end of the first year, you will need a total, you will need to return a total payment of $47,828, which will include a principal return of $35,229 and the interest of $12,498. So in this way, each year for 3 years, that means 36 months, you can return the total principal, which will be, in this case, if you will add all these value, it will be $120,000. And then you will make some interest as well. So $120,000, which is the amount which you originally got, but these are the extra expenses, interest, which you will be paying. Okay, so this is the situation. Actually, we cannot, we should not try to verify that whether will be actually paying this amount. So this is the information which we have, which has been agreed between the contractor and the bank. Okay, that they will pay them back this much interest.
Professor,
okay,
I have a question.
Yes.
How much money we decided to take from the bank?
We will we will take $120,000.
So a down payment, it means it's our own money, yes?
Yes, down payment will be from your pocket. Yes.
And also, total principal, what does it mean? Like,
yeah, the principal is the that means the original actual amount which you have taken. So that means the total you will return $47,000, in which the actual amount which you will return is $35,000. The remaining $12,000 is the
interest of the bank, yes?
Interest of the bank.
So it's like, so this total principal, how did we like create these numbers? Are they taken from the depreciation of the equipment or?
No. It's nothing related with the depreciation. Actually, we can create these numbers, but I think we don't get this number. I tried to create these numbers, but I could not get it. But anyway, we have to we can take these numbers as the one which is supplied by the bank. Okay, so we have to use this number in our analysis. That is, this is kind of like a given data to us. Okay, so we should not try to create these numbers. I think we will not get these exact numbers over here. Although we can verify that the total principal 35, 39, 44, that comes out to be $120,000. So which is correct. But if you will try to tally the amount of interest, I think it is not going to will not come up with these numbers. So this is the data which has been provided to us by the bank. And then we agreed to pay to the bank this much interest at the end of first year, this much, second year, this much, third year, this much. Okay. So for the depreciation, we will use that information later on in the analysis that I am going to explain. Okay.
Okay.
Yes, so the down payment is $30,000. So the reason for the down payment is that because the bank actually wants to make sure that the contractor to who we are giving a loan is capable of something. Okay, I mean so that means if the contractor can pay back this $30,000, so the bank will have the guarantee that, well, the contractor is financially sound. At least he can pay $30,000, and then he will be also able to return that the remaining $120,000 to them. So of course, $30,000 there is their own monies, but it is kind of like it serves as a guarantee to the bank that contractor is capable. Anyway, then we have this another option. So this was the these are the data which we used for the buying option. For the leasing option is that the term of the lease is 5 years. The lease payment is $2,800 per month, and the initial payment required is 3 months in advance. So it means that you need to pay like for 5 years, $2,800 per month. So for the first 3 payments will be in advance, okay, and in for the remaining years, in the last year maybe then you don't have to pay for 3 months. So in the last year you will pay for like 12 minus 3, that is 9 months only. So that will be the only difference in this case. In the rental assumption, the rental period is 5 months, month to month. But in that rental assumption, there is an option that you can stop renting it after any period, okay? Maybe 2 months, maybe 3 months, maybe after 24 months, you can stop renting it. So the rental rate is $5,150 per month. So remember that although we are evaluating this case for 5 years, the period of the loan is only 3 years over here in this case, okay? Okay, so now let's go to the analysis. And here the present worth factors have been provided. So these present worth factors, I think, can be calculated like this. So I can show some. So these are the present worth factors. So for example, for year one, the present worth factor is, so these are the mid-year present worth factors, average of the start. So we know that the present worth factor is present value is equal to the future value divided by 1 plus the I is shown by the interest rate and I power n. N is the number of years. Okay. So in this case, the present worth factor is, that means if we know any future value, if the future value can be converted into its present equivalent by this factor, present worth factor. Present worth factor, it will be 1/1 plus I power n. So this 0.96297 is the present worth factor for the year one. But since they said that they are using the mid-year present worth factor, so for year one, this value will be 1 divided by the interest rate, which is 8%. Remember that this interest rate is the same as the after-tax rate of return. That means we want to evaluate our investment opportunities at 8%. 8%. So it will be 1 plus 1, 1 over 1 plus 8%. 8% is 0.08. Okay, 1 plus 0.08 power 0.5. So if you will calculate it, 1.08 divided by 0.5, so you will get this answer. Similarly, this value will be 1 over 1.08 power. What will be that value, power? Will it be 1.5? Yeah, because we are talking about the mid-year. So this will be 1 over 1.08 power 2.5. Okay, so this will be 3.5, this will be 4.5, and just at the end, okay, just at the end, it will be 1.08 power 5. Okay, at the end. So since we will be using these values over here in the table after, so that's why I tried to explain it over here. Okay, so what are these values over here in this table? So here you can see that first the main structure of this table is that the years have been shown in the horizontal order. So initial period, that is time 0. At the end of year 1, basically it is the mid of year 1 actually. Yeah, so we are talking year 1, actually we are talking about the mid of year 1 and the mid of year 2, mid of year 3, mid of year 4, mid of year 5, and then at the end of year 5. Okay. So here in this case, we have arranged these numbers in this way. So what are the payments? Okay. So payments are $30,000. What was that amount? This was the down payment. Okay. So what we have paid over here is the down payment. Initially $30,000, which we paid for this investment. And then we paid 47,829, 47,829, and 47,829. So these are the 3 payments we made. All right. So what are these payments made for? Can you tell? These payments are made for the
credit.
Yeah, for the loan. For the loan. Okay. So we took a loan. Yeah. So this is for the down payment. Okay, down payment. This was the down payment, and these are the payments for the loan. That is, we took a loan of $120,000. Okay, these 3 payments. Okay, so this makes it our first line. Okay, and then in the end, this is total has been represented. This total we can add all these amounts. So this total actually, well, this we can use it as a reference only. Okay, and then there is this resale values. That means we said that we can sell it back at $60,000, at $60,000, but that will be at the end of year 5. So here we have represented $60,000, but in the parenthesis over here means that because here we are taking these are the costs, okay? Well, normally the costs are represented with negative numbers, but here we are representing the cost as positive numbers over here because our analysis mostly is based on the cost values. Okay, so most of the numbers are the cost values. So we are using cost for the positive numbers. But this is some kind of income for us. That means we will be getting back $60,000 when we are selling that equipment. Okay, so in this case, if the costs are positive, so the income over here will be a negative number. So this number in the parenthesis in the accounting term is a negative number. But of course, here in this case, since we are representing the cost as positive number, the incomes we are representing as negative number. So take these values in the parenthesis as the negative numbers. Okay, so it is minus $60,000. So this is the resale value. Got it? You got this point? Hello?
Yes.
Okay.
What is
Then,
tax resale?
what is tax at?
Resale.
I have
Ah,
not. Now I'm going to explain it, right? I just started from line 1 and then line 2, and now you are asking about line 3. So I'm going to explain the line 3. Okay, so this is a tax at resale. Okay, now just understand the concept of the tax. Okay, the concept of the tax is that tax. Okay, tax you pay. Okay, you pay, for example, if you are a contractor, tax you pay on net income. Okay, tax you pay on net income. On the other hand, you can save the tax you save on tax you save on net expenses. Okay, you can say that, right? So if you have the expenses, you save the tax. That means if your expenses are more, your income will be less. That means you will be paying less tax, or it means that you will be saving on the tax. Okay, so in this case, tax at resale is given as 27,600, which is basically the tax rate has been given to you in the question. Tax rate has been given to you 46%. Okay, so whatever will be the income, there will be a tax. So this $60,000 is an income in that year. So there will be a tax of 46% around that. So this means 26,600 will be the tax that you will pay. Okay, tax that you will pay. So this is also $47,000 that is you are going to pay, and then this is the $60,000 is the income. Okay. So 46% of that. So this $60,000 you get from here to here by multiplying by 0.46. Okay. Okay. Now we are talking. Yeah.
Payments. So look, the equipment, the price for equipment was $120,000. Yep.
$150,000.
50,000. Okay. And we have a loan. We took a loan from bank for 120,000. Yep.
Yes. Yes. Yeah. The price of equipment was $150,000, but we did not pay $150,000. We only paid $30,000. We only paid $30,000, and then we paid $40,000 to pay the loan. Okay. In this case, now we have, okay, I have explained these first 3 lines. Now I'm going to explain this 4th line. This is the tax saving for the depreciation. Okay, so what does it mean? And now you see this line, which I have said. Okay, where is this line? Okay, when first I said tax you pay on the net income. So this is the same over here, $26,600. This is the tax you pay because you had the income. But tax you save, Okay, save. Okay, I'm not saying that tax you will get back. That means the government is going to return you. You will be saving the tax on your net expenses. Does it make sense?
No.
No. Why? If
How
you
can I save?
no, if you pay something, okay, if you pay something for your net income, then you can save the tax on your net expenses. Okay, this is just logical. So it means that this $9,832 amount you will save. How did we get this $9,832? Okay, so this $9,832 is on the depreciation. Okay, on the depreciation, and the depreciation is taking place on this cost basis of 142,500. Just look at this data. Okay, depreciation will take place on $142,500, and depreciation is a cost. Okay, so what will be the depreciation? This depreciation will be 15% in this first year. Okay, so 152,000 times 0.15, that will be the depreciation. Okay, so on this depreciation, you will, because this will be the cost, okay, this will be your net expense, there will be a tax saving of 46%. Okay, so if you will multiply 142,500 multiplied by 0.15, 0.46, can you tell me what value you get? Calculate and tell me the value.
$9,832 and
Yes,
5.
it's the same. Yeah, so it's the same. It's the same and this value.
Can I?
So, but
What does mean 142 500?
this is the cost basis. Cost basis. And this cost basis is used for calculation of the depreciation. So this is the cost basis. And then this is the depreciation.
Is it like amortization? Yep.
It is like what?
Amortization, yep.
No. Amortization is here. Yeah, amortization is for the loan. It is not amortization. Okay, it is the depreciation. Okay, so these are the tax savings due to the depreciation. So for the second year, 14,421. So you will, how you will calculate it? 142,500 multiplied by 0.22 multiplied by 0.46. So same as the cost basis. For the second year, this is the depreciation rate, this one, and then 46% is the tax rate. So you will get 14,421. So therefore, you will get it all this for the 5 years, these values. Okay, so these are your tax savings. Okay, tax savings. So the sign is opposite to that. Okay, so if you have the tax payment on the net income, you have the tax saving on the next expenses. Okay, so these are the tax savings. Okay, now there are tax savings on the interest as well. Why? Because interest is an expense. Interest is an expense. Okay, so since these are the expenses, 12,480.98, so these interest payments are also tax deductible. So you will get 5,749 over here. So how you will get 5,749? The interest in the first year was 12,498.73, the same. And then you will multiply it by 0.46. Since it is an expense, the saving in the tax will be 0.46. So 12,498 multiplied by 0.46, what is that value? $12,498 multiplied by 73 into 0.46. What is the value? Can you tell me? It will be the same, right? 5749. So this 5749 is equal to 12498, right? Multiplied by 0.46. So since interest is an expense, its tax saving will be 5749. Can you just confirm me like this? 12498 multiplied by 0.46 is 5749. Is it correct? Hello? Can you multiply it and tell me the answer? Okay, so similarly for the for the second year, 8018. So it was 8018 multiplied by 0.46. So it is 3688. And then for the third year, it was 2969 multiplied by 0.46, it is 11366. So then after that, there is no interest payment. So therefore there is 000. Okay, so in the last line over here is before we will add up everything, that is the investment credit. So there was also an investment credit as well. So that means that is also a saving. So we will put it in the year one over here, although we can put it in the initial period as well, but I think somehow this book has put it in the year one over here. So that is fine. Okay, so this is the investment credit. So this is also a saving. So this investment credit is given by the government or by the supplier. It can be from anywhere. Okay, so $15,000. So you will add up all these values. So how you will add up? 47,829 minus 9832 minus 5749 minus 15,000. That will make it 17,248. Okay. 47,829 minus 14,421 minus 3688, that will make it 29,720. And similarly, you will get all these values. Okay. So from here now, since these are the future values, okay. So for example, if this is the present value, for example, 30,000, this is the present value. This is the first future value. This is the second future value. This is the third future value, and so on. Its corresponding present value will be represented by like this. So present value is equal to the future value multiplied by 1 over the 1 plus I power n. In fact, we have already calculated 1 over 1 plus I power n as these present worth factors. Okay, as these present worth factors. So therefore, this from 17,248. So for the first one, it is of course 1. So that will be when, and then it was like 0.96. 0.9629. So if you will multiply it by its present worth factor 0.9629, okay, and then it will be multiplied by its present worth factor 8914.8914, and so on, all this. So then you will get these values, this value, this value, this value, this, and this, and this, and this. So all of these values are in the present term. So that means this $30,000 is in the present value, and then $16,000 is the present equivalent of this value in the first year, in the middle of the first year, and then $26,000 is the present equivalent in the second year, and then all of these are the present values. So now you can simply add up all these values, plus this, plus this, plus, and then of course this is the negative value, because when we will add up, and then these will be negative values. So you will get this value. So this is the present worth, okay, present worth of buying. Okay, present worth of buying. So present worth of buying, that means in terms of the cost. So it will cost $57,785 in present worth values. When we consider for this investment for 5 years period, if we will buy this equipment. Okay. So do you understand the calculations in this? Hello.
Yes.
Okay. Okay. So remember that in this case, we have considered this situation after the tax. Okay. So the tax so the main, I think this is the main concept. Okay. So you pay the tax on income. Do you agree with that?
Yes.
If you have the income, you pay the tax. Okay. But if your income is less, you pay less tax. Okay. You also agree with that?
Yes.
Okay. So if you have more income and then later on, if you have less income, that means you are saving on the tax, right?
So I cannot understand this moment actually still.
Uh-huh.
Save. I mean like.
If your expenses are more, that means you are saving on the tax, right?
Yeah, but no one give me this taxes.
Give,
No one
no
give me
one give you, no one give you what?
the money.
No, no one is giving you money. You are just saving it. Okay. You are saving. Yes, saving is not like you are getting the money.
How can
I'm
we?
not saying. I'm not saying that you. I'm not saying like this. Okay, here, tax you get. I did not say this. I think I tax you save. Okay.
Okay, but how can we include it here? So
Why cannot we include it? Okay, because this is mathematically this is from the mathematics, right? You save. That means if your expenses are, we are including it because just we are saying that our expenses are increasing. Okay. Or remember, and one more thing. Okay, one more thing. This analysis is only considering the costs. Okay. If I think it will be easier for you to understand, then I think you will say, oh, okay. Yeah, then I understand. If I, for example, if I include the operating income, that means if, for example, if we are using it and then we are getting some income from that machine, and then we will be using it. But of course, we are only evaluating it in terms of the costs. So that's why we are saying it. Okay. So these are the tax savings. Saving is not like you are just literally getting it. Okay, it is a saving. That means saving means you are paying less tax. You are okay. You can understand it in this way. That means first, if for example, if previously you have to pay like a $1,000 tax, now you are paying like $500 tax. You are paying the tax in both situations, but compared with 1,000. In the case when you are paying $500, you are saving a tax of $5,000. So this is what I am saying. I'm not saying that you are getting back those $500. Okay, so this is the figure for our $57,785. This is the figure for our comparison. Okay, so this is one figure which we get from the buying option. And the other figure which we are going to get is from this leasing option. So in the leasing option, the calculations are relatively simple. The initial lease is for 8,500, right? That means initially you pay like, because the lease was for 2,800 and initially for 3 months lease is required. So initially you pay 8,500. So this is at time 0. Okay. And in the year 1, then you will pay for 12 months, so 2,800 times 12, so you will pay 33,600. So same in year 2, year 3, year 4, and in year 5, because for 3 months you already have paid, you will not pay like more than like 60 months. So in the last year, you will pay 2,800 times 9. So it will be $25,200. So since these are the expenses, okay, these are the expenses. These are the expenses. So the savings on the expenses by the same case over here is that saving on tax savings on the expenses, tax savings on the payments are like multiplied by 0.46. So you will get these values. Okay. So after getting these values, so then what you can do is 8,400 minus 3,848. So it will be 4,566. Then you will add up these values. 33,000 minus 15,000, 33,000 minus 15,000. Okay. So in this way, you will get this cash flow. So this is multiplied by 1. This is multiplied by 0.96 as previously by the present worth factors. So you will get these values and then 0.89. These present worth factors, you can add up, add up, and then you get this present worth of leasing. Okay, present worth of leasing. And in the case of the rental amount was, I think, what was the rental amount? 5150, okay? So 5150 was the rental amount. Okay. So 5150 times 12. So each year you pay 61,800, 61,800. Same calculations performed, okay, over here. And then you add up all these values, you get 138,576. That means if you will rent it for 5 years, your present worth of cost will be 138,576. So in this case, the best option is the buy. Buy is the best option. If you use it for like 5 years. Okay, so with the condition that if used for 5 years. Okay, if used for 5 years. And for 5 years and then 2,000 hours per year. Okay, so this is the best condition. Buy is the best option because the cost was only 57,000. Present worth of the cost was $57,785. So if the present worth of the cost is the minimum, then that is the best choice. If we also have the income data, okay, so present worth of the income minus cost, then present worth value, the higher present worth value should be the better choice over here. So is it clear, this question?
Yes.
All right, so let's move forward. And then we see this chart over here. So this chart compares the buying, leasing, and renting option. So in this case, we have 3 curves over here. For the renting, there is this horizontal curve over here because the renting does not depend on how many hours we use. So for example, if we say that if we use for 5 years, right? So if you use, for example, if we have like option this 2,000 hours per year. So that means each year will be 5 years. So for 5 years, total usage will be 10,000 hours. Okay, so for 10,000 hours, we can see that the value for the buying was like this over here in the number of hours. So for example, earlier we calculated like 57,000 something, right? 57,785. 57,785 dollar per year. So if we divide it by 2,000, if we divide it by 2,000, so then that amount will be 57,785. So what will be that amount? 28,000, right? So no, 2,800. 57,000 divided by 2. So it will be, yeah, just take 2. So it will be 2, 2, 4, 8, right? 2,800, 28 point something, okay? 28 point something, $28, right? So if it is 2,000 hours, then then this value will be dollar per hour will be 28, right? If we use for a total of 2 years, that means total 4,000. So the dollar per value will be this. So, and that means if it becomes 4, 57,785 divided by 4. So this value will be around for here will be this. So similarly, the value will keep decreasing with the higher usage. And the same will be the case for the lease as well. But in the case of the rental, we are going to pay the fixed amount over here. Okay. So here we can see that at about at less than about 2 years of use, for example, 2,000 hours per year is this one. If at less than about 2 years of use, renting is better than buying, because in this case, the usage level will be less. So therefore, in this case, if you want to buy the equipment, we have to use this equipment for longer period of time. Similarly, the same case is for leasing option, but for the leasing, the costs are slightly higher than the buying option. So this is what the chart says. Okay, next is the financial management of construction. So the 4 major factors which include the incur the failure of the companies are the inadequate cost of accounting and poor management account for over 80% of all failures. Okay, so this means that the basis for statement earlier in this topic that the financial state management of a construction company is equally as important to company success as it is technical management is apparent. So I think the remaining slides are something about the financial planning. So it includes cost estimating prior to bidding or negotiating a contract, and forecasting the project income and expenditure or cash flow, and determining the amount of work that construction firm can safely undertake at one time. So the cost estimating for a project involves estimating the total cost to carry out a construction project in accordance with the plans and specification. And the costs that must be considered include the labor, equipment, materials, subcontracts, and services. So indirect or job management costs. So yeah, these labor, equipment, materials, subcontract, and services costs are the major components of the direct cost. Indirect cost or the job management cost and the general overhead or offsite management costs. So indirect cost is the job management cost, that means the costs at the job site, or the general overhead cost, that means mainly the costs incurred at the company's head office. Okay. A finance schedule or cash flow schedule shows the planned rate of project expenditure and project income. So it is common practice in the construction industry for the owner to withhold payment for a percentage of the value of the completed work, referred to as the retainage. So this aspect is also worth noting, that there is a system of retainage in the construction industry. That means when a contractor works on the project, at the end of the month, the contractor will send the bill to the client, and the client will check the work, and whatever will be the bill, the client will retain some amount from the bill and then return the remaining amount. So for example, maybe if the retainage percentage is 5%, so the 90% of the amount of the bill will be returned to the contractor, 5% will be retained. So this retainage will be given back to the contractor normally at the end of the contractor when all the completed work, all the work has been completed, or for a very long-term project, maybe at the end of each year, and then the next cycle of the work may start. So hence the project income will almost lag behind the project expenditure, which means that the contractor will have to spend some amount first. And then when the contractor gets back the payment, it is not that amount of payment which the contractor has spent. So therefore, contractor will always lag behind in the project expenditure. So the retainage amount, of course, the amount of retainage which is held by the client is just for the guarantee that the contractor will try to complete the project and the contractor will not be excessively paid. Okay, so this provides a kind of guarantee to the client of the retainage work. So the difference must be provided in cash from the company's assets or borrowed fund. It means that since the contractor is now lagging behind in getting the payments back from the contractor, therefore that difference the contractor can offset by their own fund or by some borrowed money. That means they can take the short-term loan, or they can take some line of credit, etc. So the construction industry relies heavily on the use of the borrowed fund for this purpose. So therefore, the finance charges associated with the use of such funds, as well as the maximum amount of funds available, are important considerations in the financial planning of a construction project. So when the amount is borrowed by the contractor, so that means the contractor will be paying the interest on that amount. So that interest also becomes also another expense which the contractor must take care of. So when a financial schedule may be developed manually from any type of project schedule, the use of CPM methods will facilitate preparation of financial schedules. So of course, this CPM method is very useful for creating the financial schedules. So as we can see from over here, this chart is that three kinds of schedules can be made. So one can be the proposed schedule, the other may be the early start schedule, another one may be the late start schedule. So for example, if we have a CPM schedule, okay, let me draw it over here. So for example, if we have this project network, okay, if we have certain project network, like that, okay. I'm not doing any calculations. I'm just showing it like in qualitative terms. So from this project schedule, we may have a bar chart. Okay, just suppose this is the bar chart. Okay, on this bar chart, we can show the expenses. So for example, this take like 2,000, this take like 3,000, this take 500, this take 1,000. And then on daily or weekly basis, we have the expenses, 500, 600, 700, and then we have the cumulative expenses. So if we can plot against time, so this is the time, and these are the dollar amount or the expenses over here. If we plot this time against these dollar amounts, so we can get this kind of curve. I think we earlier talked about this S curve as well. So we can get three types of S curves over here. So one can be for the normal schedule. That means when how we have scheduled the activities. Okay, how we have scheduled the activities. The another curve which can create is for the early start schedule, where we have scheduled all activities at their early start times. Yes, at their early start times. And then we can create another curve where we have scheduled all the activities at their late start times. So we can get three kinds of curves. So proposed schedule, late start schedule, and the early start schedule. So this means that it shows that this critical path method, in consultation with the bar chart method, we can create a project cost versus time curve, which may be very useful for evaluating that where we are standing in the project. However, we use some other curves as well, such as this. In this curve, we can see three kinds of curves. So one is the dashed line curve, shows the expenditure. Okay, so we can use these proposed schedule. Okay, proposed schedules. This is the same curve as for the proposed schedule. Okay, so we can. These are the expenditure curves, proposed schedules. And then this is the solid line curve, is the value of the completed work. So maybe our value of the completed work, that means how much work we have completed. And then we can plot on this graph with the passage of time. So we can get this solid curve over here. So all this information we can plot with the help of the CPM or directly from the project planning and scheduling software. But on the same plot, we can also on the same graph, we can also plot the receipts curves. So here you can see that for the receipts curve, we are getting a stair type of curve. Why? We are getting a stair type of curves, and this stair type of curve is below our expenditure and value of the completed work. Why is it that? Why are we getting this stair type of curve? Yes, can you tell me the reason? Why this receipts curve is a stair type of curve? Hello? Everyone sleeping?
Because like buying something is added to the recipient, it gets higher.
Okay. Yeah, you have tried to answer it, but anyway, the answer is that because I have just said that the contractor spends the amount first, okay, then sends the bill to the client, and then client pays the bill. So for example, if the contractor has performed the work at the end of the first month, contractor has performed this much amount of work, as I can see this, my laser point, this much amount of work. But the contractor will get the payment for that amount at the end of the next month, maybe normally at the some fixed period of time. So if the contractor has spent like $1,000, okay, at the end of first month, that $1,000 minus any retainage, the contractor will get at the end of the second month, because there is some payment schedule. So therefore, the payment to the client, payment to the contractor, that is the receipts of the contractor, will always lag behind in the by the amount of work which has been done. And it is in the staircase because the contractor will not get these receipts in a continuous manner. It will the contractor will get those receipts in a regular manner at the end of each month, or the payment schedule which has been decided or agreed between the client and the contractor. So that's why there is a stair curve, and that stair curve is also lagging behind. So one curve, so the reason in short is that this is the stair curve because the contractor gets the payments at specified periods of time. It is not continuous. It is lagging behind because the payment is only made after some time period when the bill is submitted, and also lagging behind because it's there is a normal retainage practice on the bills of the contractor, and that some of the retainage has been done. And in this case, in the case of this final payment, as you can see that, then in that situation, when the work has been completed, the final payment is then the big one. And then suddenly the contractor can get back to all this amount at the end of the contract. But within the, during the project, the payments are always, the payments to the client are always lagging behind the work which they have done. All right, so that's all. That is what I wanted to explain today. So the remaining, there are some remaining slides as well. Maybe we can complete those quickly in the next lesson, and then we can start another topic next week. Okay, so I finished today at this point. Okay, so yeah, any questions?
No.